My name is Farhan. Today you are going to solve question number 9 from 2015 past exam. This question requires you to prepare the operating activities section for the budgeted cash flow statement, the income statement, and also discuss two benefits for preparing budgets on a monthly basis. You can get to see the question on the left hand side of the screen and all the workings on the right hand side. If you need tutoring sessions, make sure to check the link in the description to book a call with me. With that being said, let's get started. Terrace Timbers has recently commenced reporting on a monthly basis. The business sells on credit and pays cash for purchases. The business has provided relevant account balances, both actual and budgeted for October 2015. So here you can see we are given some asset and liability accounts, and we are given the opening balance at 1st of October 2015 and the budgeted closing balance at end of 31st October 2015. You're also given some budgeted additional information for October. And the first requirement of the question is to prepare the operating section of the budgeted cash flow statement for the month ending 31 October 2015. So what we're going to do first is go through each and every additional information that we have and understand all the different complications that are involved. Now, before we begin, I want you to understand something. So you see within the account balances that we're given here, debtors control are what we now refer to as accounts receivable. So because this was part of the old curriculum prior to 2019, we would call accounts receivable debtors control. They mean the same thing, which are your credit customers or the people to whom you have sold goods on credit. So, given that we understand that debtors control is the same as accounts receivable, so let's proceed with the first additional information. The first line says that the business expects credit sales of $50,000 plus GST in October. Now, based on the first paragraph of the question, we understand the business always sells on credit. So whatever sales we are making for the month of October is credit and therefore needs to be included within the accounts receivable. So on the right hand side, you can get to see that I have constructed a ledger account for accounts receivable. Now, accounts receivable refer to the credit customers of the business. These are the people to whom the business have sold goods on credit. So these credit customers are the assets of the business, technically a current asset because you want to get the cash as quickly as possible. Now, assets within the ledger account should always have an opening balance on the debit side and a closing balance on the credit side. Also, assets, when they increase, we debit them, and when they decrease, we credit them. So on the debit side of the ledger account, which is this side, you can see that I have included the opening balance at 1st of October, and that is $48,000, and the closing balance on the credit side at 31 October, which is $51,000. You can get these numbers from the account balances that we have been provided for debtors control. As you can see, on 1st of October, the opening balance is 48,000 and the closing balance at 31 October is 51,000. Then you can see that on the debit side, for the month ending 31 October, we are including sales, including GST, and that is $55,000. Based on the first line that's given in the additional information, which says that the business expects credit sales of $50,000 plus GST in October. So if the credit sales are $50,000, then sales plus GST should be $50,000 plus 10% of 50,000, which gives us 55,000 in total as the total amount that we expect to receive from our accounts receivable. And the reason this is included on the debit side is because whenever you're making credit sales, your accounts receivable as your assets are increasing in value. Therefore, you expect to receive more economic benefits in the future. And when assets increase in value, we debit them. Now, you also can see on the credit side the amount in cash that we have collected from our accounts receivable for the month ending 31 October. And I've highlighted this because this is the amount that is the missing figure that we had to derive ourselves. So how do we derive this number? So let's just assume we don't have this to begin with because this is what we expected to calculate. So we find the total of everything on the debit side, which is to add 48,000 with 55,000, and that gives you 103,000. This must be the total of everything on the credit side to ensure the fundamental rules of accounting apply. And once you subtract the closing balance of 51,000 from 103,000, you get 52,000, which refers to the cash that you have collected from your accounts receivable, the cash that you have already collected from your credit customers. Now, the reason we are including this on the credit side as well, because logically speaking, when you're collecting cash from your accounts receivable are going down in value, which means assets are going down in value, and therefore you're decreasing it by showing it on the credit side of the accounts receivable asset ledger account. So that is the first working, and maybe we can also put this number in the cash flow statement now. So you can see the outline was already given to us, and I've included cash received from accounts receivable of 52,000 as a positive because this is referring to cash collections. Now let's move on to the second additional information that we're given. Wages paid will be $23,200. All right, so here it specifically mentions the word paid, wages paid. So this refers to wages paid for cash. This is directly mentioned to us, and we can confidently say that within the cash flow statement operating activities section, we could include wages paid for cash of $23,200, which is what you can see we have done here. And we are showing this within brackets to reflect an outflow or a negative number. However, we still have other complications to solve. Now, if you check the account balances that's given to us, you can see that we have an opening balance for accrued wages on 1 October of 1,700 and closing balance of 1,900 at 31 October. Now, accrued wages refer to wages that the business has already consumed or incurred but haven't paid for them yet. This serves the definition of a current liability, which is a present obligation for the business for benefits that it has already taken from employees. Now you can see that I have created a ledger account for accrued wages, which is a current liability account. And you can see I've included the opening balance and the closing balances there. Now, accrued wages is a current liability account, and liabilities by default should always have an opening balance on the credit side and the closing balance on the debit side. Liabilities, when they increase, we credit them, and when they decrease, we debit them. So it's basically the exact opposite treatment for what you would do with assets. So accrued wages being a current liability account, so on the credit side, I've included the opening balance of $1,700, and on the debit side, I've included the closing balance of 31 October of $1,900. Then I'm also including bank of $23,000 on the debit side. And why is this the case? You see, we are preparing the ledger account for accrued wages, which is a liability account to begin with. So if we have paid for wages, that refers to a reduction in liability. And liabilities, when they go down, we debit them within the ledger account. So this bank of $23,000 is the exact amount that we had shown within the cash flow statement operating activities section as wages paid for cash, which simply refers to a reduction in accrued wages or the wages that the business owed. Now, our main requirement was to calculate this part. which serves as the wages expense, and it's the same method as how we calculate for any missing figures within the ledger account. So we find the total of everything on the heaviest side, which is the debit side. So 1900 plus 23,200, which is 25,100. That must be the total of everything on the credit side. And when you subtract the opening balance of 1700, you are left with 23,400, which refers to wages expense for the month of 31 October. Now, wages expense is shown on the credit side of the accrued wages account. And any wages that the business consumes, any expense that the business consumes, which in this case is wages, it is going to increase the present obligation of the business. So therefore, when expenses go up, the liabilities should go up. So that is why on the credit side of the accrued wages account for the month ending 31 October 2015, you can see wages expense of $23,400. And this expense, this amount of $23,400 is what we are going to include in the income statement. And this amount is what we have shown in the cash flow statement, which is $23,200. Now let's move to additional information number 3. Rent is paid 3 months in advance at $2,000 per month plus GST. The next payment will be in October. The rent charged will increase by 10% from 1 December onwards. Right. So we need to be very careful with the way the sentences are structured. First of all, we understand that rent has been paid 3 months in advance. And in this case, the next payment will be in October, which is the month we are concerned about in this question. Now, a lot of students might think that the rent we have paid in advance in October and the rent which is covering 3 months, a lot of students would think the first month is actually October and the second month is November and the third month is December. But this is not the case. The question clearly mentions that rent is paid 3 months in advance and the next payment will be in October. But it doesn't explicitly mention whether or not the rent is paid at 1st of October, which covers the entire month of October, or not. Another way you can verify this is by checking the prepaid rent balance at 1st of October of $2,000. Now, this prepaid rent balance of $2,000 at 1st of October refers to prepaid rent already carried forward from previous period, from end of previous period. So that means this $2,000 would be expensed in October, right? But whatever we are paying for 3 months in October, that doesn't really cover the month of October itself. It starts covering from November, followed by December, and then followed by January. So let's do all the calculations that are involved. So rent prepaid in October is equal to $2,000. That will cover November. A 10% increase in December, which makes it $2,200. And then $2,200 again for the month of January. So these are the 3 months that we are covering for the rent that will be paid in advance in October. And that is $6,400 in total. The GST that you have to pay separately on the rent is 10% of 6,400, which is 640. And the rent expense for the month of October is $2,000. And this $2,000 is expensed based on the fact that we have an opening balance of $2,000 for prepaid rent on 1st of October. And we also understand by reading the question that the initial rent is $2,000 per month. So obviously the prepaid rent, which is the current asset, referring to the economic benefits for rent we are yet to consume at 1 October, will be consumed entirely in the month of October and therefore be expensed, and we will call it rent expense of $2,000. And this rent expense of $2,000 for the month of October is what we're going to show in the income statement. All right, so let's move on to additional information number 4. So interest on the loan is $5,400 per annum. It is paid half yearly in March and October. Right. So it's not as straightforward as it looks. Many complications are involved here. So you can see, based on the question, we understand that interest per annum is $5,400, which means the monthly interest is 5,400 divided by 12 months, which is $450. Right. Now hold that thought. So if the monthly interest is $450 and we understand that the business has started reporting on a monthly basis and we are only concerned about what happens in the month of October, and in the month of October, which is 1 month, the interest should be there for $450 as the interest expense, right? So interest expense is $450 for the month of October, because we're only concerned about 1 month at the moment when we're preparing the financial statements. But we also understand that in terms of cash, we understand that the interest expense is $540, but that doesn't necessarily mean cash though. The treatment for cash when it comes to interest is different. They have said they're paid on a 6-month basis. All right, so if the monthly interest is 450, then 6 months should be 2,700, which is simply dividing the annual interest with 2. Now here I have drawn a timeline to explain what's happening. All right, so we understand that we pay interest in March and in October. And whenever we are paying for interest, it covers 6 months. Right. So in between March and October, which is the month that we're concerned about, we had 6 months, which are April, May, June, July, August, and September. These interests would have been expensed and they would not be paid for in cash, and they would be accrued, because the question clearly mentions interest is paid half yearly in March and in October. So after March, we have 6 months, April, May, June, July, August, September. And those 6 months would be accrued in terms of interest. So therefore, the opening balance for accrued interest at 1st of October should be $450 on a monthly basis multiplied by 6, which is $2,700. All right. And the accrued interest at 31 October, what do you think it should be? The accrued interest at 1st October, we understand that's accrued for 6 months, and that is $2,700. We also understand this $2,700 would be already paid in the month of October, because interest is paid half yearly. So if this $2,700 is already paid in the month of October, and that $2,700 covers the previous 6 months before October, which is April, May, June, July, August, and September, then in the month of October, the only accrued interest would be the interest for the month of October itself, and that is $450, because everything before October has already been taken care of, so there's nothing really accrued. So the only thing accrued at end of 31 October is the interest expense for the month of October itself, and that is $450. Right? Now, let's prepare the ledger account for accrued interest. So accrued interest, we understand, is a liability account because this refers to interest that we haven't paid yet. So this is a present obligation for the business for any benefits it has taken, which is the loan. Now, because this is a liability account, the opening balance should always be on the credit side, and the closing balance should always be on the debit side. Also, when liabilities increase, we credit them, and when liabilities decrease, we debit them. So on the credit side, you can see the opening balance on 1st of October of $2,700, which is based on our calculations that we had done just a while ago. And the closing balance is on the debit side, 31 October of $450 based on our discussion a while ago. Now this highlighted bit here is what we had to derive ourselves. So we'll come back to that bank thing. But we also understand that interest expense for the month is $450. So any interest we have expensed, that is going to increase the balance for accrued interest. So that is why liabilities are going up and we are crediting it. All right, so that refers to the 1 month of interest expense. So debit interest expense 450, credit accrued interest expense of 450, basically referring to the fact that whatever interest you have consumed for the month of October, you haven't paid for it yet. So how do we find this missing figure then? Same thing as before, we find the total of everything on the heaviest side, which is the credit side. So 2,700 plus 450 gives us 3,150, which must be the total of the debit side. And once you subtract the closing balance of 450, you are left with 2,700, which refers to the interest that you have actually paid for in cash. And this also exactly matches what we have calculated ourselves in terms of the 6 months of interest that have accrued from April until September, and which is what we will be paying for entirely in October. And that would be $450 times 6, that is $2,700. So either way, it logically makes sense whether or not you calculate it from the accrued interest ledger account, or you can choose to just simply find the monthly interest of $450 and times it by 6, which is $2,700 as the interest paid for in cash. So check the cash flow statement. I've included interest paid $2,700. I've also included rent of $6,400 from our previous step, which refers to rent prepaid. Now let's move on to additional information number 5. Straightforward. Cost of sales is 50% of sales revenue. So cost of sales is 50% of $50,000, which is $25,000, and cost of sales is reported in the income statement. Be careful not to include GST here. GST is a completely different thing in itself. So that refers to the GST clearing account, which is a liability account. Cost of sales only talks about the original value that is relevant to the inventory, not the GST, because GST is things to do with the government. So do not include the GST here. So 50% of 50,000, which is 25,000. And cash purchases of stock are budgeted to be $18,000 plus GST. All right. So cash purchases are $18,000. Specifically mentions cash purchases. And this is also valid based on the first paragraph of the question, which says the business sells on credit and pays cash for purchases. So if the cash purchases are $18,000, that is what we're including in the cash flow statement. And the GST that we would be paying on these purchases should be 10% of 18,000, which is $1,800. 18,000 being the dollar amount for purchases that we have made for cash. Now, let me take you to the cash flow statement, and you will see that I have included cash purchases of stock, $18,000 in negative, which refers to the outflow. Now, before we look into depreciation, I want to show you the total GST that we have actually paid in terms of cash that we are including in the cash flow statement. We are paying GST on the prepaid rent, and the amount of prepaid rent excluding GST was $6,400. 10% of $6,400 gave us $640 for the GST that we paid on rent, and the GST on purchases, which you have just seen, we derived to be $1,800, and that's $2,440 in total. And because GST paid refers to cash outflow, it's reflected as a negative number here within the cash flow statement. All right. So depreciation doesn't really have anything to do with cash flow statement, because cash flow statement simply refers to cash inflows and outflows. And as you know, depreciation is a non-cash expense. All right, so you just add and subtract whatever you need to do, and you get the net cash estimate from operating activities, and that should be negative $740. Now let's refer to additional information number 6 for depreciation, which is pretty straightforward. So depreciation on the machinery is 12% per annum straight line. Right. Before you jump straight to the calculation though, you need to check the account balances properly. You can see that the balances for machinery at 1st of October and 31 of October it's not really changing. So which refers to no machinery being purchased and the old machinery is still in use. So this 90,000 refers to the cost of the machinery that we have. And given that the depreciation rate is 12% per annum straight line, so you see what we do in terms of calculations. So 12% is the annualized rate, divide by 12 to make it monthly, which is 1%. Just multiply simply on the cost of $90,000 and you get $900 of depreciation of machinery, which is an expense and therefore needs to be included in the income statement. Nothing to do with cash because this is a non-cash expense, which only refers to the loss in the value of a non-current asset as it gets utilized over time within the business to help the business generate more revenue. So that's basically what depreciation is. All right, so let's look into part B, which is to prepare the budgeted income statement for the month ending 31 October 2015. Pretty straightforward now that you have all the numbers. So sales are $50,000, not 55, because the 5,000 refers to the GST, which goes to the GST clearing liability account. Then we subtract cost of sales of 25,000 based on our working. 50% of sales is cost of sales. And once you subtract cost of sales from sales, you get the gross profit of $25,000. We do not have any other revenue or other income to add in this case. Normally, you would see stuff like discount revenue and all those things. We do not have that. Then you subtract all the expenses. So we start with wages expense of 23,400, which is what you can see on our calculations here for wages expense, 23,400 that we had done before. Interest expense of 450 based on the 1 month of interest that would be accrued. We had a whole discussion on that. So 450, depreciation of machinery of 900, which we just calculated. Make sure to adjust it on a monthly basis by dividing 12% with 12. And then we have rent expense of $2,000, which is the expense of rent for the month of October. So rent expense for the month of October is $2,000. We do not have any other expenses at all. And just add all the expenses, which gives you the total of $26,750. And once you subtract the total from the gross profit, you get a net loss of $1,750. All right, so this is a very common question, and I believe you have got this question many times in other exam papers as well. So we won't be surprised if you get a similar question in the upcoming 2024 exam in November. So let's look into part C. So what's part C asking? So part C is saying, prior to October 2015, the business budgeted on an annual basis, but now it budgets on a monthly basis. State 2 benefits of preparing budgets on a monthly basis instead of an annual basis. So just simply mention the 2 benefits of preparing budgets on a monthly basis. All right, so in terms of benefits, if we budget more frequently, we can detect any unfavorable trends. And these unfavorable trends could relate to any inefficiencies within the business that we need to fix. Also, are we collecting cash on time from our accounts receivable or our debtors? And once we could identify any unfavorable trends, we have the time to fix it as management. And the way we fix it is by taking corrective actions, which allows us to improve the performance of the business. So what do we refer to by corrective actions? This could relate to things like how can the business minimize wastage? And how can the business increase economies of scale? How can the business achieve higher profit margins? How can the business increase positive cash flow? as you have seen, based on our estimation for the operating section of net cash flow, it's 740 negative. So these are key things that we could look into as corrective actions to fix. So if you are budgeting on a yearly basis, you wouldn't be really able to fix what's necessary on time and therefore achieve higher profit margins and better performance for the business. Because if you have negative operating cash flow for a long time, you would not be able to understand whether or not you can grow the business by investing on non-current assets because your cash flow is negative. So you do not have sufficient capacity to survive in the long run, but can probably barely make it in the short run. Benefit number 2 is monthly budgeting provides management with a lot of information with regards to seasonal trends. Now, when I say seasonal trends, you could identify which months are very busy and best for business and which months are not as good and are very quiet. Because if you could identify that as management, you could formulate your strategy accordingly to how you can make the most margins based on the busiest seasons or the busiest months. This could be, for example, you identifying, okay, during the busy months, do we have enough cash which allows us to buy inventory quickly and sell that inventory for profit? Also, you could think about, okay, during the busy months, can we give discount to our customers that allows them to pay us promptly and quickly? So if we could do that, then we could get the cash quickly and we could utilize it within the business and increase the cash flow. So these are the 2 types of benefits you could look into. And it's just very simple, 2 marks. You can easily get 2 out of 2. I believe that. So nothing to worry about. So that's all for today's lesson. So I believe you found a lot of value in this content. Make sure to like this video and subscribe to this channel. And I'll see you in the next lesson.